webinar is going to be about dairy revenue protection. You will also see that acronym DRP throughout our webinar this morning. Our focus today is going to be on providing you, our participants, with information on dairy revenue protection to help manage your risk. Also, we're going to review the federal crop insurance structure as it relates back to a livestock policy. And of course, we're going to talk about how to engage the services of a livestock insurance agent and where you can find that information at. But let's first consider the relationship between the farmers and that make up the federal crop insurance program. The federal side is split into the Federal Crop Insurance Corporation, or otherwise what you might know as FCIC, and the Risk Management Agency, or RMA, with RMA acting as the manager for the FCIC. The Federal Crop Insurance Corporation role is to establish new and revised commodity crop insurance programs, program policy provisions, rules and regs, including those for livestock. As far as the Risk Management Agency, again, otherwise known as RMA, they manage the FCIC, they oversee the livestock insurance program, administer the actuarial data, and premium discounts, and provide support and outreach. Throughout the webinar, I may refer to the approved insurance provider as an AIP, the insurance provider, or your crop insurance company. During our time together today, all these terms refer to the company described on this slide. At present, there are 14 crop insurance companies that have signed an agreement with the federal government to write the federal product, also known as MPCI. And we have just as many also writing the livestock product. As far as approved insurance providers, they obtain strategic reinsurance agreements with RMA to sell service the federal crop insurance policies through independent licensed agents, including those for livestock. The agent provides product and premium information to the insured. They also collect the required information on approved forms, including the application, specific and coverage endorsement. They build the relationships with farmers. Now, as far as the agent goes, they must stay current with the livestock insurance program, meaning that in order to sell the DRP product, agents must have taken 3 hours of training specifically for that plan and pass the competency exam. And then every year after that, agents must attend training and get updates on the policy and the handbook and other things related to the livestock product. They do receive a policy commission from the insurance provider. The linchpin of this relationship is you, our farmers. You, the farmer, have ownership in the livestock. You enter into a contract to insure it. You must report the required information, pay applicable premiums, and you may receive an indemnity payment. Now, one of the most important things I want to talk about is how do you actually buy a policy? Where do you go to find an agent? So the screen in front of you actually shows a copy and paste screen for the Risk Management Agency website. And you can see here, we provided that website address for you at this point. If you go to that website, take a look where we're pointing the arrow, you can click on Find an Agent. And once you do that, you'll come to a screen that looks like this, where again, you click on the RMA Agent Locator, and it takes you to this screen that I'm circling here. Now, you can actually search by distance and crop, and since we're talking about livestock, you can actually click on livestock to find an agent that is certified to sell this product. You could take a look at languages, distance, or if you know a specific agent, you can also write the agent name in there. So to summarize, as far as buying a policy, you must buy the dairy revenue protection insurance through a livestock insurance agent. Again, the majority of them are also crop insurance agents. You can fill out an application at any time. However, insurance does not start until you buy a quarterly coverage endorsement. And we're going to dig in deep as to what the significance of an application versus a quarterly coverage endorsement actually is here in this webinar. So let's take a look at the overview of the Dairy Revenue Protection Program. First of all, American Farm Bureau Federation, along with the American Farm Bureau Insurance Services, developed this product. It kicked off in September of 2018. This is a product that provides protection against declines in quarterly revenue from milk sales. It is quarterly coverage, which means it can be sold up to 5 quarters, with the exception of the last sales period that only has the availability of only 4 quarters. And a little bit later in this webinar, I'll actually show you a chart that hopefully makes it a little bit more clear what that means. With this product, there are 2 pricing options. We have a class price, which is a classified milk price. There's also a component pricing. This is a combination of milk components such as butter, fat, protein, and milk solids. When I talk about component pricing, which means the policyholder or the farmer can actually choose the percentage of butter, fat, and protein. And I'll get into those details here in a moment. Also in this product, you choose how much milk production to cover during the quarter. New for this year, the coverage level percentage have changed to 80 to 95% in 5% increments. This is an index product using state level milk production. And a little bit what we mean by that is once the monthly milk and component prices are announced for the quarter, and USDA's milk production report identifies the actual milk production per cow for each state, the state indexed actual revenue will be compared against the revenue guarantee. If the actual revenue is below the guarantee, the farmers paid a policy indemnity based on the difference. So mainly, if you're a farmer, there are 5 decisions you really need to make on this policy. First of all, the value of the milk protected, the amount of milk production to cover. Again, you need to choose the level coverage, again, from 80 to 95% in 5% increments, which quarterly contract you wish to purchase, and a protection factor. Now, I've devoted a couple slides talking about the protection factor. Most of this you'll need to choose on the quarterly coverage endorsement. But let's jump first in the application, because like I said from the very beginning, you have to complete an application with an agent and have that process before you can actually buy a quarterly coverage endorsement. So let's take a look at the application and what information you need to know about that. So one of the main things that we get on this policy or hear about is when can we actually buy? This policy has a sales closing date, a sales period begin date, and a sales period end date. Now that's a lot of information, a lot of sales periods here. So hopefully if you take a look at the slide, I've broken it down for you. So let's take a look at the very first one. You may buy each day prices are made available, and that's referred to as the sales closing date. So each date in a specified sales time frame during which coverage is available for purchase is the definition of sales closing. Moving on, quarterly endorsements may only be purchased at certain times of the day. So our sales period begins when coverage prices and rates are validated, and that's usually somewhere between 2 and 4 p.m. each day. It ends at 9 a.m. Central Standard Time the following business day. So if the expected milk and dairy commodity prices are not available on the RMA website by 4 o'clock p.m., this product will not be offered for sale for that insurance period. Our third bullet, quarterly endorsements may be bought for the next quarter, or you can purchase up to 5 quarters with the exception of the last sales period where only 4 quarters are available. So in saying that, there is a sales period begin date. So the actuarial documents on the risk management website contain a date citing the first date coverage for a specific quarterly insurance period becomes available. Lastly, the endorsement purchase periods are limited. So there is a sales period end date. That's a date also in the actuarial citing the last date coverage for a specific quarterly insurance period will be available for coverage. So when I show you this chart here in a little bit, you're going to see that's going to be a little bit more apparent to you as far as when you can actually purchase those quarterly endorsements and how long you have before the end date. Usually that sales period end date is usually 2 weeks before coverage begins. So for a January, this is just an example here, for the January through March coverage period, that sales period actually ended December 15th. And I'll show you a few more examples here in a little bit. All right, so let's first talk about the application submission. The application can be submitted at any time during the crop year. I'd recommend that if you're interested in this product to do it as soon as possible because it must be received by the agent no later than the sales closing date for which coverage is requested under a quarterly coverage endorsement. So the whole point of the application is you want to complete the application process to ensure eligibility. Also, early completion will confirm conservation provisions compliance, a beginning farmer, rancher, or veteran if that's applicable to your circumstances. Your agent may also want to review records to verify your entity, tax ID number, and record retention. Remember, we need to confirm the records needed later in the event of a possible loss. Now, even though the agent may want to review milk marketing records, those records are not required with the application. Dairy revenue protection is a continuous policy. It does remain in effect until canceled by either you or the insurance provider. All right, so you've heard me talk over and over already about the quarterly coverage endorsement. Let's talk about that because that endorsement is what it takes to establish the coverage for this product. All right, so as far as the quarterly coverage endorsement, in order to obtain coverage, you must submit this form within the chosen sales period for each quarterly insurance period that you elect coverage. You may select multiple quarterly coverage endorsements for the same insurance period, but they cannot cover the same pounds of milk. So again, you can submit quarterly coverage endorsements for the same quarterly insurance period, but they cannot cover the same pounds of milk. As far as the endorsement, it's necessary to provide coverage. Some requirements to establish the coverage. Again, you need to declare the covered milk production, choose a coverage level, choose the type, either class pricing or component pricing, choose the quarter, declare your share, knowing though that the expected prices will change daily. And we're going to talk about where those expected prices come from because they come from the Chicago Mercantile Exchange. And I do have a bit of a slide about that. Expected values are released on a daily basis after 2, but before 4 o'clock. All right, let's take a look at this chart here. Hopefully this is going to make it a little bit more plain as far as when you can buy the quarterly coverage endorsement and during what period. So the quarterly insurance period refers to the quarter or 3-month period selected for coverage. If you take a look at this chart, you can see that here. We have the October, December, January, March, April, June, July, September, and so forth. So here there's 8 there are 8 quarters available for coverage during a year. A producer can purchase up to 5 quarters into the future on any sales closing date. So let's take a look about where we are right now. We're in this period right here We're in the sales date of March 16th through June 15th. And take a look here of the 5 periods open: 804, 805, 806, 807, 808. And you can see if you go up the column as to what the quarterly coverage period actually is. So the ones for July, September, October, December, and these 5 are all available right now from March 16th through June 15th. Throughout the crop year, there are always 5 quarterly insurance periods available for quoting premium and obtaining coverage, with the exception, though, of June 16th and June 30th. As you can see, for June 16th and June 30th, there are only 4 coverage periods available for sale. All right, so as we take a look at this chart, keep in mind a couple things. It is possible to have multiple quarterly coverage endorsements providing coverage for the same quarterly insurance period with different crop years. For example, I'm just going to throw out an example here. A farmer with, 200 head of dairy cattle may buy an endorsement for the July-September sales date on May 15th for 75 cows. Then you could buy another endorsement for the same insurance period, perhaps on May 31st for another 100 cattle. Just a way to dip your toes onto this product, kind of get the hang of it. But again, you can have multiple quarterly coverage endorsements as long as it's not covering the same milk production. All right, I know we reviewed this a few slides ago, but hopefully now it might make a little bit more sense. So let's take a look at the sales closing date and sales period one more time. Coverage is available for purchase each day. That coverage usually begins when the coverage prices and rates are validated somewhere between 2 and 4 on a daily basis. Again, if it's not available on the risk management agency website by 4, then this product's not going to be available for sale for that insurance period. Again, it ends at 9 a.m. Central Standard Time the following business day. Let's talk about the declared covered milk production. Now, these next few slides are additional information that's needed on the quarterly coverage endorsement. So keep that in mind as we go through here. As far as declared covered milk production, in order to establish liability and calculate the premium, you, the farmer, needs to declare the number of pounds of covered milk production on that endorsement. You may choose different amounts of declared covered milk production for each type and practice. Remember, there could be multiple endorsements for the same insurance period, but I emphasize they cannot cover the same milk. All right, I did say at the very beginning of our webinar, we're going to talk a little bit about that protection factor. I mentioned that, I think, in about the 4th slide. So let's just delve into that just briefly. This is a numeric value chosen by you for each type of practice. It's between 1.00 and 1.50 in 5% increments. It's used to calculate the policy protection and impacts both the premium and indemnity proportionally. You may choose a different protection factor for each type of practice as indicated on your endorsement. This next slide is just to cover any of the few just remaining issues that you will need to choose on your quarterly coverage endorsement. First of all, the declared share. This is just your % interest in the insured milk as an owner at the time insurance attaches. If there is somebody else sharing in the crop, if you have less than 100% interest in the milk, you need to list the ownership share. And the expected milk production per cow. So this is the expected milk production in pounds per cow. This is posted in the actuarial documents for the quarterly insurance period and for the pooled production region in which the dairy operation is insured. Now, that's one thing I haven't talked about yet in this webinar is pooled production regions and the commodity exchange endorsement, which is the last bullet there. I'm not going to delve too deeply into the commodity exchange endorsement during this webinar, but I will tell you It is on the Risk Management Agency website, and once you locate a livestock agent, they can certainly go over those pool production regions with you in detail. All right, so we've talked about pricing options. We've talked about class pricing and component pricing, and you're probably wondering exactly what that entails. So let's go through that in the next few slides. I want to just give you a quick overview in this slide as far as the class pricing option. This uses a combination of class 3 and 4 milk prices based on your declared class price weighting factor. The component pricing option, a little bit more details on this one, and a few more options that you get to choose for this option. This is a combination of butter, fat, and protein, and also the other solids value. This is based on your declared butter, fat, and protein test. Now, one of the things I want to remind you is you may purchase separate endorsements for the same insurance period with different elections. You can switch between the class pricing option and the component pricing option. The main thing that you need to remember about the pricing options is that they're designed to allow you, the farmer, to customize your price selections to reflect your price risk. So let's go into the class pricing option a little bit more here. This again is expected class 3 and 4 milk prices. They're published on the actuarial documents on each day that sales are offered. You, the insured, choose a weighted average mix of class 3 or class 4 options. You're allowed to declare your class 3 price weighting factor anywhere from 0 to 100% in 5% increments. The default class 4 weighting factor is 1.00 minus the declared class 3 weighting factor. So what this actually means to you here. Let's take a look at the chart. I just copied and pasted a little bit from the handbook here. And this is a really easy chart. This farmer here chose the 50% weighting factor for the class 3. And of course, what's left over is the 50% on the class 4, but you could switch this up any way you want. If you want to choose 65 or 0.65 for class 3, the remainder would be 0.35. You could do 75, 25, whatever makes sense for your price risk is what you need to choose for this class pricing option. As far as component pricing option, one thing I want to remind you is the daily Chicago Mercantile Exchange future prices for butter, cheese, and dry whey for the months within the quarterly insurance period are used in the expected butter fat price, the expected protein price, and the other solids price using USDA milk pricing calculations for that sales period. So let's take a look at that slide. So when you are choosing and making choices on your quarterly coverage endorsement, you're going to review the expected values per pound for butterfat, protein, and other solids that's published in the actuarial documents for the date you chose coverage. The elections allow you to establish coverage for prices to mirror your expected milk components. So you need to declare both your butterfat and protein test pounds. So let's take a look at that declared butterfat test here. This is the pounds of milk fat contained in 100 pounds of milk. Your choice can be no less than 3.25 pounds and no more than 5 pounds in 5-pound increments. As far as the declared protein test, again, this is milk protein contained in 100 pounds of milk. Can be no less than 2.75 pounds and no more than 4 pounds in 5-pound increments. The other solids test will always be fixed at 5.7 pounds per 100 pounds of milk. So that's really not a decision you need to make. That is a fixed amount. All right, so that is a little bit, I covered so far the application process, the quarterly coverage endorsement, all the sales dates involved in choosing your coverage dates and what needs to be chosen on your quarterly coverage endorsement. So let's now take a look at the notice of probable loss. This is a little bit down the road now. You've had coverage for your chosen periods, and now let's talk to see if you might have an indemnity and what it takes to get an indemnity. So there's 3 bullets here on this slide I want to go over. The first one is a notice of probable loss. This is where the insurance provider or your crop insurance company We'll send the notice generally 10 days after all the dairy revenue protection data for that quarterly insurance period is released. Now let's remember what the cause of loss actually is on here. This product only provides insurance for the difference between the final revenue guarantee and the actual milk revenue times your actual share and protection factor. Indemnity payments are usually made within 30 days following the receipt of the claim form from you, milk marketing records from you, and the milk production worksheet that's completed by you. So let's go into a little bit more detail on those things. As far as an indemnity goes, to receive an indemnity, you must return the notice of loss to your insurance provider within 60 days after issuance. Make sure you include that milk production worksheet and your milk marketing records. Now, that milk production worksheet, this is a production worksheet that must accompany the notice of the loss in the marketing records. You provide the records from the dairy operations milk co-op or the milk handler that corresponds to the quarter you had insured. Now remember, if you chose that component pricing, the records must show the component levels in the milk sold. We're talking about the butter, fat, and that protein. Let's go over a few more dairy revenue protection, just a little bit more information, hopefully some more information to add to your toolkit as far as information. Sales may be suspended. Now, there are 4 instances here on this slide that we want to just briefly go over. Sales may be suspended if unforeseen and extraordinary events occur that interfere with the effective functioning of the markets or the milk production reports. May be suspended on calendar days on which USDA releases the milk production report, the cold storage report, or the dairy products report. Also, in the event of a limit movement of any milk futures expiring during the insured period. And last but certainly not least, sales may be suspended if any other days that for any reason dairy revenue protection offer prices are not published in the actuarial documents. Just some brief writing, some brief procedures here directly from the policy. I did talk about expected prices in a few of our slides, and I told you that we're going to touch on where those expected prices come from. All pricing information is included on the exchange endorsement that's part of the policy. It's available to you on the Risk Management Agency website, and that will give you all the details about the pricing, but I'm going to just cover the expected price information on this slide. So daily Chicago Mercantile Exchange future prices for Class 3 and 4 milk price for the months within the quarterly insurance period will be used to calculate the expected prices. The expected price will be the simple average of the corresponding futures prices for those months falling within a given quarter of a quarterly coverage endorsement. Again, if you want to see all the details about pricing, I would take a look at the commodity exchange endorsement that's going to be available through your livestock agent, or you can go to the Risk Management Agency website for that. Let's go over the causes of loss covered. I know I've said this several times throughout the webinar, but again, it doesn't hurt to make sure we're all on the same page as we summarize this product. Remember, this policy provides insurance only for the difference between the final revenue guarantee and the actual milk revenue times your actual share in the production or your protection factor. Causes by natural occurrences and market prices and yields in your pooled production region. This policy does not insure against the death or other loss or destruction of your dairy cattle or against any other loss or damage of any kind whatsoever. Here's some additional important dates you might need to know. The contract change date is April 30th, and what that actually means to you, the farmer, is that by April 30th, if there's any changes to be made to the policy, the commodity exchange endorsement, handbooks, anything like that, Risk Management will have that out there by April 30th of each year. Cancellation date is June 30th. That's the cancellation date for your application. The end of the insurance date, of course, is the final date of your quarterly insurance period, and termination date is December 31st. All right, here's a few statistics in case you're interested. And what we did here on this slide is just put those statistics for Pennsylvania only. On the next slide, I'll cover nationwide statistics, but let's just go for Pennsylvania first. These are policies earning premium in Pennsylvania is 116. Take a look at the quantity of milk insured and also the liability, over 50 million there in liability. As of yesterday, I updated the nationwide statistics. These are insurance policy or insurance companies with policies sold. So we have 10 insurance companies throughout the nation insuring livestock. This next one is the total policies sold, over 3,700. This is insurance companies with endorsements earning premium. Again, that's 10. Total endorsements earning premium, over 7,800. So you can see this is a fairly popular product, and it's really taken off since its release last fall. Declared covered milk production, and here we have that information in pounds for you. Liability amount, total gross premium amount, and of course the producer premium support along with the total endorsements indemnified. We just have started the indemnity process. The product's fairly new, so you can see here that this was just updated yesterday. So far, 169 policies have indemnities paid, and here are the indemnity amounts at this point. I'm sure some others will be forthcoming. Again, we just finished the first quarter in March, so these statistics are fairly new. All right. Now, you might think we should be quoting in this webinar, and I probably don't disagree with that, but one of the reasons we don't is because what we cover in this webinar is a lot of different components and choices that you need to make as a farmer. So we always recommend that you, of course, find your livestock agent, and one of the things you'll want to do with your livestock agents is talking about the different class pricing, component options, the current pricing information, and other costs associated with this product. Your operation, the options available to you will definitely make a difference in the premium amount you pay. There is a risk management quoting tool available on their website. If you wish to go through that and get a quick estimate, you're more than welcome to, but we always recommend you go to your livestock agent for help with that, and you can talk about different options that may work better for your operation. So I'd certainly encourage that. I want to thank you for my time with you. I'm going to turn it over next to our Jessica Trites-Raleigh. I introduced her during our entry or our opening. So I'm going to turn over to her. She is going to discuss the early life cycle for this, go over a little bit on application and endorsement so you have a better idea of timelines, because when we talk about multiple endorsements and different class pricing and component pricing option, might get a little confusing. So she's going to go over a few slides and discuss that with you, and she will end our webinar probably here in a few minutes. So thank you, and I'll turn it over to Jessica.
Good morning, everyone. It always helps to go through an example when we're dealing with something that's new and when we're dealing with something that has a lot of different components to it, especially if you are someone who has multiple different commodities insured. So for example, you might be a primarily dairy operation, as we'll go through in just a moment, but perhaps you've also got some other crops and you're curious about how all these things work together. Let's dive in. So our purpose today is to give you the opportunity to understand how this coverage works collectively. So we're not going to focus on calculations. And we are going to focus, however, on a timeline, a farmer agent, AIP high-level activities. We're going to follow the initial activities of those individuals and companies, and we're going to take a look at when a policy transfer can occur, because we know that your risk management requires sometimes that you make changes in who you are insuring with. So we're going to follow Zoey. Zoey is a fifth-generation dairy farmer, and she is located in Wisconsin for our example purposes. Now, pretend she has been transported over to Pennsylvania, and you'll get the same sense of how this works. She's primarily in Wapaka County, and she's got 350 head of dairy cows today. She's looking, however, to expand as she takes over this operation from her dad. So she also produces, so here's a case where she's another one of those farmers who produces multiple different crops. So she's got her primary dairy operation, but she also insures corn for silage, she insures winter wheat, and she produces alfalfa, but she's not currently insuring that. Zoey, her crop insurance world includes a new agent for her. Danny Schmidt is her agent, and Danny has contracts in place with two different companies. Those are AIPs A and C. She's going to rewrite her 2019 wheat and corn coverage with Danny. So let's follow her forward. We start last fall, 2018, and we're going to come forward all the way into 2020 in our example. So first, here we go. On September 25th of 2018, Zoey and her agent Danny complete an application for revenue protection for winter wheat. And on the 26th, Danny finalizes all the entries for that winter wheat policy and places the policy with AIPA. On the 27th of September, the AIP submits all of that information to the risk management agency. Then on October 3rd, Danny attends a training session for the new Dairy Revenue Protection Crop Insurance Program and begins to consider which of his current insureds also operate dairy farms. And Zoey immediately comes to mind. He calls her up and asks if she's coming into town in the next week. They agree to meet on Friday the 5th. On the 5th, Zoey and Danny get together, and Danny explains the Dairy Revenue Protection Crop Insurance Program to Zoey, pointing out all the ways that it seems to be a really good fit for her primary business as a dairy farmer. Danny provides Zoey with copies of the policy documents and a few fact sheets and some preliminary quotes that he's generated specifically for her. Zoey takes those documents home to review and discuss with her family and her advisors. Next, as Zoey reads through that DRP policy, yeah, she really read it, and she deciphers the commodity exchange endorsement. She contacts Danny several times with questions. Once she's satisfied that she understands this new coverage, she looks at the numbers, determining how the cost benefit fits in with her other expenses and her risk management activities. On October 11th, Zoey decides to purchase the dairy revenue protection. She completes a 2019 application with Danny, and that application, and keep in mind, is to ensure that Zoey is eligible. We're not yet insuring any milk revenue. That application goes in to AIPA. Then Danny keys all the data, gets everything through system edits, and on the 12th, jump on forward, AIPA submits all that information to RMA. Now Danny and Zoey are watching prices. They watch on the 15th, the 16th, the 17th, the 18th, and finally on Friday the 19th, Zoey decides that the prices fit her needs, and she completes 5 quarterly coverage endorsements for the 2019 reinsurance year under AIPA. All of them are component pricing options. Danny keys all that data and passes all the AIP system edits timely. So here's their activity. We're following them through. And next, let's take a look at what Zoey bought. So she bought the January through March, and as Lynette mentioned, that is the quarter that in real life actually just ended, and that's where we're seeing some of the indemnity payments coming through in our recent statistics. She also purchased an April through June quarter, a July through September, an October through December, and she purchased January through March 2020. And you can see on the chart here how much she purchased. All 5 quarters that were purchased are insured in the 2019 crop year. So even though we're flowing way over into the next calendar year, these are all 2019 policy coverage. Quick note, the chart premium due date that's on this chart in front of you, that is for example purposes only. You shouldn't take that as an exact date used by any company. The chart provided assumes that your company will bill on the actual listed actuarial billing date or very near to. So to avoid interest accruing, the premium payment would be due no later than the first month after billing, provided at least 30 days have passed since the actuarial billing date. So what does that mean? That means for the billing date of 4/25, which is what just recently passed for all those producers who, like Zoey, purchased the January through March 2019 quarter, they will see interest accrual begin on June 1st because we have to pass the first of the next full month. So they've still got time to pay their premiums if they purchase that quarter without any interest accruing up through the end of this month. So let's keep going with Zoey. So what happened with that purchase that she made with all those quarters? Well, the sales for the October 19th, 2018 DRP prices ended at 9 a.m. Central on Monday the 22nd. Keeping in mind, we're looking here with dairy revenue protection at the next business day. So they had all weekend to get everything in order and make sure that they got all the data in by that deadline. All their signatures, get that data sent in. And then the insurance company will submit everything in and get them cleared through risk management agencies' edits. So what does Zoey have? Now she has her winter wheat and she has her newly purchased 5 DRP quarterly insurance periods. March, April, and May of 2019. What happens? Well, Zoey and her agent, Danny, complete an application for revenue protection corn silage coverage. On March 4th, Danny finalizes all the entries for the silage policy and places that, notice a change here, with a different insurance company, AIPC. That AIP submits all the information to the risk management agency on the 5th of March. Next, on around April 20th of this year, actual values come out for the January through March 2019 quarter. In reality, those values came out on the 23rd of April in real life. Unfortunately, after the company reviews the data that is published, they determine that Zoey did not have a probable loss for the January through March 2019 quarter. On the 25th, AIPA issued a bill to Zoey for that first quarter. That is due by the end of May if Zoey wants to avoid interest. And on May 12th, Zoey makes a timely payment. So here, let's take another look. Zoey still has her winter wheat with AIPA for 2019. She has her 5 quarterly coverage endorsements with AIPA. And now she has with AIPC a corn silage policy. Moving along into June, July, and August of 2019, we see Zoey and Danny getting back together. On June 21st, 9 days before the June 30th cancellation date for dairy revenue protection, Zoey and her agent Danny execute a transfer application from AIPA to AIPC for the 2020 crop year. On the 24th, Danny keys all the data passing all AIP system edits, and on the 25th, the AIP submits the application records to RMA. Now keep in mind, this is just the application. This is for Zoey. So she's beginning the process to move over her dairy revenue to a new insurance company. Danny and Zoey watch prices on the 15th, the 16th, and the 17th of July. On the 18th, Zoey finally decides that the prices fit her need, and she completes another 5 quarterly coverage endorsements for the 2020 crop year under AIPC. Again, she has chosen the component pricing option. Danny keys all the data, passing the system edits on the 19th. Very timely, no issues. Now let's take a look at what Zoey just did on July 18th. Now what you'll notice here is she's made a purchase for the 2020 crop year. And this time, what we're looking at is a starting month of October of 2019. Why is that? Well, when someone is signing up for new coverage or when she transferred, she can't purchase that very first quarter. So you remember that she made this purchase on July 18th. She can't buy the July through September quarter because she's already into that quarter. She also wouldn't have been able to make that purchase even if she'd purchased at the time that she transferred her application over to the new AIP. That is not an available quarter for the 2020. We always start with October through December for any given crop year. So here you can see she's gone all out again. She's purchased that October through December, all the way out through October through December of 2020. Now, on the 19th, the AIP submits all the data, and it passes all the edits at the risk management agency. Very important to make sure that she has her coverage in place. On the 22nd, they are submitting some records to make sure she's eligible and to place that coverage into a particular fund. And then also around the 22nd, the actual values, here we have another quarter, for AIPA coverage 2019 crop year are coming out. So our April through June, Zoey's second dairy revenue protection quarter with her first company are released. That company is going to look those over, and they determine, as you can see in our lower left, that Zoey may have a loss. On the 25th, as is normal, they will bill Zoey for that April through June quarter's premium. To avoid interest, she'll need to pay by August 31st of 2019. On July 30th, 8 days after the actual value publication, the AIP, Zoey's first AIP, will send her a notice of probable loss. Lynette talked through the requirements and what goes into an AIP submitting to the producer a notice of probable loss. With that, Zoey's also going to receive a milk production worksheet for the April through June 2019 quarter. She will be requested to complete the forms and submit production records within 60 days of the notice of probable loss date. On August 10th, Zoey pays her premium bill for that April through June quarter. She's timely. Apologies. And let's take a quick look before we wrap up her indemnities here. What does Zoey have? So she's still got her winter wheat. She still has those dairy revenue protection quarterly insurance periods in place under AIPA. Those do not go away just because she decided to move for the 2020 crop year. With the other insurance company, Zoey now has her corn silage, and she has additional for 2020 dairy revenue protection insurance periods. So now we're looking at September. Remember that the insurance company, her first insurance company, sent her a notice of probable loss and a milk production worksheet requesting records and completion of the worksheet. Here we are on September 10th, which is still within a time frame of 60 days after her receiving that notice of probable loss and documentation. Zoey timely submits her completed forms and her records for the April through June 2019 quarter. Based on her records, the cows in her operation produced 867,000 pounds of milk in April, May, and June. Continuing her goal of moving all of her business over to her new insurance company. And remember here, it seems like we're jumping around, but we're going in chronological order. This is what an insured is going to need to do when they're working through all the different dates and deadlines that are required by crop insurance actuarial documentation. So she's going to move her winter wheat over. She does that also on the 10th. So she's a busy lady. And then Danny keys in all the information and submits that winter wheat policy over to the new insurance company, AIPC. AIPA has been busy reviewing Zoey's paperwork for her April through June quarter. What they found is that to complete a final indemnity determination, they have to determine the policy-defined covered milk production. So although we're not doing full calculations in this timeline, we will review, we have talked about that unique process. That is a comparison where between different AIPs, they are able to determine whether an insured has some milk covered in the same quarter with different insurance companies. So keep in mind, remember we talked about that October through December, we saw that quarter on both Zoey's coverage for 2019 with AIPA, and we saw it in her first quarter that she's insuring for the 2020 crop year with AIPC. So we would run into a potential situation where those two companies are going to need to look and see how much she has insured. That is not something that you as the farmer need to understand. That's up to your companies. But just keep in mind that they are going to be looking across to ensure that they are properly making a payment to you. Back to Zoey, what happens next? The company is submitting her winter wheat, and her first company is confirming her April through June indemnity, and they issue a claim check. So now we are moving along. Her winter wheat for 2019 is now pretty much done, but it was still there. Her 2019 dairy revenue, we're moving through those quarters, but that remains in force for 2019. But now with her new company, Zoey has corn silage, she has dairy revenue, and she has a 2020 winter wheat policy. Now we're getting into fall and winter of 2019. And on Monday, October 21st, the actual values for July through September 2019 quarter are issued. AIPA determines, unfortunately, there is not a loss for Zoey. On the 25th, they do bill Zoey for that July through September 2019 quarter's premium. And then on November 8th, Zoey pays her bill timely to AIPA for the July through September premium. Now we're deep into winter, January, February, and March of 2020. We've jumped way forward in time, and now things get quite interesting because the actual values that we're waiting for in January are those October to December 2019 quarter values that I talked about a moment ago. And that quarter, as we saw, is insured with both Zoey's original company, AIPA, and Zoey's new company, AIPC. Granted, they are in two different crop years. AIPA has that quarter covered for the 2019 crop year, and AIPC has that quarter covered for the 2020 crop year, but a month is a month, and therefore there's an overlap. And that milk production that comes out of those 3 months in the quarter needs to be reported and considered by both companies. So what do? On that release date, they're going to download the values. They are going to review those values, and they determine that Zoey might have a loss, so they issue a notice of probable loss to Zoey. Also, 5 days later on the billing date, both of them will bill Zoey for the October through December quarter. AIPA will bill for the 2019 crop year, and AIPC bills for the 2020. And she will need to pay by February 29th of 2020. Yep, it's a leap year, in order to avoid interest. Moving along, we hit January 28th of 2020. And now they are issuing the notice of probable loss. They have confirmed that she appears to have a loss in that quarter. And because of that, both companies, different crop years, will be issuing her the forms and documentation request that she needs to complete and return to them within 60 days of the notice. So she'll need to return them by around the end of March 2020. Zoey timely pays her October through December quarter premium to both AIPA and to AIPC. Zoey submits her documentation to AIPA for her 2019 quarter, and she submits the same information to AIPC. Remember, it's the same month, so it should match. Now, AIPA on February 19th and AIPC also on February 19th are separately reviewing Zoey's loss paperwork, and they determine the covered milk production. That's what they're going to use in order to determine her final indemnity payment. AIPA on the 26th of February 2020 confirms that she has an indemnity, and they issue that claim check and a final proof of loss to Zoey. And on the 27th, AIPC also confirms that she is owed an indemnity payment, and they issue the claim check and the final proof of loss. In April, May, and June of next year, we're waiting for some actual values for the January through March 2020 quarter. And that quarter is insured with AIPA for 2019 and with AIPC for 2020. So again, we've got an overlap. They're downloading the information, and unfortunately, they determined that Zoey does not have a probable loss based on the data that was released by the Risk Management Agency for actual values. They do issue a bill for that particular quarter, and in order to avoid interest, Zoey will need to pay that bill by May 31st of 2020. So you see, we're moving way into the future. This product does stretch over a significant amount of time. On the 19th of May, Zoey timely pays her January through March 2020 quarter premium to AIPC. On the 1st of June, however, and this could happen for any number of different reasons, Zoey realizes she did not pay her January through March 2020 quarter's premium to AIPA on time. And so interest will begin to accrue on June 1st for that premium she owed. So what happened? So here's all of Zoey's policy information. We're going to get a little into the weeds here, but this gives you a good idea when you have a bit of a more complex operation and you have multiple different types of coverages, what might happen with your coverage if you're not on time with your payments, and how it might affect your other crops. So here we see Zoey's winter wheat, Zoey's corn silage, and her various dairy revenue protection quarterly insurance periods, both with AIPA and with AIPC. Keeping in mind that the reason we still show both is that even though we're into the 2020 calendar year, we still have those overlapping quarters from 2019's crop year that stretch into that calendar year for AIPA. So here's her unpaid premium, January through March. Let's talk about what happens. So this is important, and we're hoping that you'll not run into this situation. But if Zoey fails to pay AIPA her overdue dairy revenue protection premium and accrued interest before, let's back up a sec, December 30th, 31st, see here on our chart, December 31st, termination date. She will be placed on, this is another acronym for you, the ineligible list, the ITS or ineligible for crop insurance list. Her coverage purchased with an effective date after October 19th, 2018. So remember, that was her original purchase with her first crop insurance company, AIPA. Anything after that will be voided. So she will lose that coverage. Everything that's with AIPC, she would lose that coverage, and she would need to repay the indemnity that AIPC had issued to her. She will not lose what she had purchased on that particular date with her first crop insurance company. However, overall, no matter what happens, she does owe that premium to AIPA and any accrued interest. So it's really important to make sure that you're paying timely. And that goes for any crop insurance, but particularly when you are receiving bills on a frequent basis, as you will with the dairy revenue if you purchase multiple quarters, it's important to make sure you're getting that check in. Now, if her premium interest stays unpaid, she could also affect her corn silage policy and her winter wheat policy. That is with the other, or her second crop insurance company, AIPC. Now notice those stretch way out into the future. So again, we would hope that that would not happen to Zoey and that she could preserve her coverage. But if we play out the scenario, this is what could happen. However, if Zoey pays before March 15th of 2021, she will retain all of her corn silage and winter wheat coverage. And if she pays even earlier, it's possible she could preserve all or most of her coverage. So many issues here to consider. Hopefully you'll be able to go back through the slides and take a look at the various scenarios and track through the dates of what happened with our example producer Zoey, and consider what you might want to do with all the information that Lynette shared and with this fairly high level example. We thank you for your time today, and we hope that this was beneficial to you. We hope that dairy revenue protection is something that you'll consider it for your dairy operation or for those dairy producers that you work with. We hope you'll work with them to better educate, to ensure that they're making the right decisions for their operation. We appreciate your feedback, and we look forward to giving you additional information on our next webinar. Thank you very much.